Hey everyone, and welcome. So, if you're an accounting student, you know that feeling, right? You're staring at a consolidation problem, and all those adjustments for internal transactions just start to make your head spin. Well, don't worry, you are in exactly the right place. Today, we're going to pull back the curtain on these internal dealings and make it all make sense.
So here's our game plan. We'll start with what I call the consolidation puzzle. Then we'll unlock it with the all-important single entity rule. After that, we'll dive into the nitty-gritty, how to eliminate simple transfers, and then tackle the trickier stuff like unrealized profits. And finally, we'll put it all together to see the true final picture.
All right, first up, the consolidation puzzle. Seriously, why can't we just add everything up and call it a day?
I mean, it seems so logical, doesn't it? You've got a parent company, it owns a subsidiary, just smash their financial statements together and you're done. But if they've been selling things back and forth, you create a huge mess. You end up double counting and inflating everything: revenue, expenses, assets, liabilities. It gives anyone looking at those statements a totally misleading picture of how big the group actually is and how well it's really performing. And that leads us straight to the solution, the single entity rule. You guys, this is the golden key. If you understand this one concept, everything else about consolidation starts to click into place. I love this analogy because it makes it so simple. Just think of the entire corporate group, parent, subsidiaries, the whole shebang, as one big household. Now, if you move 20 bucks from your savings account to your checking account, is your household any richer? Of course not. The total amount of money is exactly the same. You just shuffled it around. That is precisely what intragroup transactions are. And in proper accounting speak, this is what we call the single economic entity concept. The entire purpose of consolidated financial statements is to show the world what the group looks like as if it were one single unified company. We have to ignore all that internal shuffling of cash and goods. And listen, this isn't just a nice theory, it's a hard and fast rule. The accounting standards, here we're quoting ASB 1, are crystal clear. They say that all intragroup stuff, balances, transactions, income, expenses, has to be eliminated in full. That means our job is to find any business done within the family and completely cancel it out. Okay, theory's over. Let's get practical and see how this works. We'll start with the easy stuff, eliminating internal transfers. So what kind of internal noise are we filtering out? Well, you've got your common ones. If one company loans money to another, we've got to cancel out the loan receivable against the loan payable. If the parent charges the subsidiary a management fee, we get rid of the revenue on one side and the expense on the other. And a big one, which we'll look at right now, is when a subsidiary pays a dividend up to its parent. Okay, so let's walk through a dividend payment. The subsidiary declares it, so they book a dividend payable. The parent gets it, and they book dividend income. But from the group's perspective, this is just moving cash from the left pocket to the right pocket. No new wealth was created. So our consolidation adjustment does the exact opposite of those original entries. We basically perform a journal entry that makes it look like it never even happened. And check this out. This shows you exactly what happens on the consolidation worksheet. Company A has a receivable for 50 grand. Company B has a payable for 50 grand. Our elimination entry in the middle there zeroes them both out. So when you look at that final consolidated column, poof, they've completely vanished.
Okay, we've nailed the simple transfers. Now it's time to level up and get to the really interesting stuff, reversing unrealized profits. This is where we handle sales of inventory and assets between companies in the group. This right here is the critical concept you have to grasp. From the group's perspective, a profit is only truly earned when something is sold to an external, outside customer. So if a subsidiary sells inventory to its parent company and makes a little profit, but that inventory is just sitting in the parent's warehouse at the end of the year, that profit hasn't really been made by the group yet. It's what we call unrealized. So to fix this, we need a two-part adjustment. First, we reverse the entire internal sale. That stops us from artificially inflating the group's total sales revenue. Then, and this is the key part, we have to take that unrealized profit out of the value of the inventory that's still left. This gets the inventory back down to its original cost to the group, not the marked up price it was sold for internally. But wait, it gets even more fun. There's a tax twist. The company that made that internal sale, it probably paid income tax on that unrealized profit. But since the group hasn't actually earned the profit yet, that tax payment is kind of like a prepayment. So we have to record a deferred tax asset to show this, which has the nice effect of reducing the group's total tax expense for that year. Now, what happens next year?
Well, the unrealized profit that was stuck in this year's closing inventory is now sitting in next year's opening inventory. So when that inventory is finally sold to a real customer, the profit is now officially realized by the group. Our adjustment in that second year will actually increase the profit to make sure it gets counted properly.
And guess what? This exact same logic applies to big ticket items too, not just inventory. If a parent sells, say, a machine to its subsidiary and books a gain on the sale, that gain is completely unrealized from the group's perspective. We have to eliminate it and reduce the asset's value on the consolidated balance sheet.
So you might be wondering, how does the group ever recognize that gain? It happens slowly, piece by piece. Because the asset is now on the subsidiary's books at a higher price, they're recording more depreciation each year. Our consolidation adjustment, year after year, will reverse a little bit of that extra depreciation. And over the rest of the asset's life, that process slowly and correctly recognizes the original gain. It's pretty clever, actually.
Phew. Okay, that was a lot of adjusting. So, after all that work, what's the payoff? Let's take a look at the final consolidated picture and see the true financial position of our group. This slide just sums it all up perfectly. Before we do anything, the numbers are inflated and distorted. Sales look bigger than they are, inventory is overvalued, and net profit is just plain wrong. But after our eliminations, we get the real story. We see the true sales to the outside world, inventory at its original group cost, and a net profit that genuinely reflects how the group performed.
So if you take away just one thing from all this, let it be this. These elimination adjustments are like a powerful filter. They strip away all the internal noise, all the back and forth chatter, and they reveal the group's true, clear financial performance as a single entity dealing with the outside world.
We've covered a ton of ground on how to do these adjustments, but let's end with a little food for thought. Now that you know how to correct the numbers, how do you think these changes would affect key financial ratios, like profitability or asset turnover? That's where this all starts to get really powerful. Thanks for watching.